Morning. This is Eric Jefferson presenting the market observations call for September the 26th, 2022. To kick things off here, have a quick word to keep the lawyers happy. And diving right in, recapping last week, continued to see equity volatility. S&P trading down over 4%, bringing year-to-date returns within 1% of their June lows. Granted, do have some green on the screen this morning. At least on the equity side, the bonds continue their sea of red, and that's following the steady march higher for yields. Driver of volatility last week continues to be the Fed. They came out with their 75 basis point rate hike. Granted, that was widely expected, but I think caught the market off guard. We got some additional clarification on where the Fed believes terminal interest rates will be, or ultimately how high they will go before they pause and eventually reset lower. Through the dot plot, which is a collection of different governors' opinions on what that rate will be, consensus came out to be 4.6%. That was somewhat higher than the market has expected for much of this year. As a result, now see the expectation for additional 75 basis point rate hike in November, an additional 50 basis points in December thereafter. And just to put the monumental rise in interest rates that we've seen this year in perspective, going back to January 1st, there were some calling for maybe 3 or 4 25 basis point rate hikes. We had some of the more hawkish individuals coming out calling for high single-digit rate hikes over the course of an entire calendar year. In the last 2 months alone, we've had the equivalent of 6 25 basis point rate hikes, as well as several hundred leading up to that. So again, has been a truly historic once-in-a-lifetime year for fixed income. When we think about typically bonds being that safer, more conservative portion of a portfolio, obviously that's come under great pressure. And again, you would not be given a hard time if you never wanted to own bonds again after the experience year to date. That being said, from a positioning standpoint, again, the higher that rates continue to go, one, that offers now investors more income or more yield that they receive for owning those bonds. Two, it means that in theory we have less hiking to do. At some point, when interest rates are when the terminal rate is reached, whether that's 4.6 or whatever, if rates don't march higher, then bonds, start to offer more of that safe haven component to them. Long-winded way of saying are getting more constructive on fixed income. Not that they're ready to back up the truck and start buying just yet. Certainly something that does remain on our radar for the short and intermediate term. From an equity standpoint, continue a fairly conservative positioning, although at some point do think you may see us take that back to more of a neutral allocation. Not in any way to suggest the market couldn't trade lower from here. However, it does start to feel like we are closer to the end versus the beginning. When we think about current price targets, Goldman Sachs came out, adjusted their year-end forecast for the S&P to be 3,600. How you back into that is a 15 times price to earning ratio times a $240 earnings estimate. Now, granted, we are very close to that metric today, and taking a less constructive view, say earnings came in 10% lower than expectations, 15 times the 220 EPS gets you to 3,300. Again, that would represent an additional 10% to the downside, but in many ways, that is a worst case scenario. You hate to say that because things can always get worse. But again, at this point, I think you're really starting to reach that emotional stage of selling off. People even jettisoning those higher quality positions likely think that may provide an attractive entry point here at some point, especially for those individuals with a longer term time horizon able to withstand some volatility. When you think about ultimately what it would take to stop the bleeding, to have a more constructive outlook for risk assets, one would obviously be softer PMI data. We get that next reading on October 13th. Secondly, would be if we did say a meaningful uptick in earnings, a theme we've continued to talk about for some time. Earnings have been very resilient. Profit margins remain near all-time highs. Again, that has been a function of companies able to pass along those higher input and those labor costs to their end consumers, without seeing demand come under pressure. We'll kick off earnings season in about 2.5 weeks here. That will certainly be closely watched. See if we can get any additional guidance on what demand looks like, how profitable those companies continue to be. And then lastly, point we've talked about week after week would be if we ever got a dovish Fed pivot. Dovish refers to the Fed not taking that hawkish approach, pounding the table to raise interest rates higher and higher and higher to combat inflation. Granted, Powell has time and time again come out, reiterated that hawkish approach. Although two things to keep in mind, if we did start to see some softness in the labor market, say initial jobless claims around 300,000, I think that would give enough cover for the Fed to maybe back off their stance. Granted, we are nowhere near that just yet. Additionally, the other thing to keep in mind is history is somewhat on the side of a dovish pivot. There is some precedent here that historically the Fed will blink on raising interest rates in the face of an economy coming under pressure. There's a graph that shows prior expectations of a terminal rate and then what actually happens. Again, theme we've talked about for quite some time. Very easy for Powell to pound the table. We're going to be as hawkish as we need to be to combat inflation. Once those recessionary fears start to come to fruition, likely we may see a slightly different tone there. But again, to reinforce, nothing that we have seen him communicate this year suggests we are anything close. Turning to FX markets, not necessarily something we talk a great deal about, but one theme that has continued throughout this course of the year has been the strength in the US dollar relative to other currencies. Part of that is we are raising interest rates faster than virtually every other country. Also, the dollar benefits from its safe haven nature. If investors are unsure of the geopolitical or even the investment landscape, dollar tends to be a very safe place to park your assets. The benefit to US consumers of a strong dollar is, in theory, we now have greater purchasing power for foreign-made goods. The trade-off, though, is for the goods we manufacture domestically and then sell to foreign investors. Stronger dollar means those goods are now more expensive, and as a result, that typically puts downward pressure on demand, meaning that has a negative impact on our GDP. Secondly, from an investment standpoint, when you think about these large multinational companies that can have 30, 40, 50% of their revenue generated overseas, for reporting and auditing purposes, those overseas dollars have to be translated back to US balance sheets. As a result, that stronger dollar becomes somewhat of a headwind, meaning those revenues generated overseas are now worth less on US dollar terms. That obviously has a negative direct impact on a company's profitability as well. So something we will continue to focus. Nothing on the short term suggests that trend will reverse anytime soon, but not necessarily a positive when we think about the broader implications from an economic standpoint. Turning to the data ahead, this week we get Case-Shiller housing data that will speak to home prices. Again, expectations are for those to start to decline. As much as that has a negative impact on the average American's net worth, one thing to keep in mind, housing prices represent a huge part of CPI. So again, if we're going to make any meaningful progress on CPI coming down, unfortunately, going to have to see home prices come under some pressure here. Expectation with interest rates and mortgage rates being as high as they are, I do expect home prices will be trending lower at some point. As well, we'll get revised Q2 GDP on that topic. One of the things we've talked about for the last several months has been the Atlanta Fed. They have a tool that will project future GDP for Q3. Their estimates currently coming in about 0.5 or half a percentage point. Again, that is meaningfully lower than the long-term average of 2%. However, keep in mind, that is certainly higher than the negative prints we have received for the first half of the year. Something continue to watch very closely. Obviously, markets are not the economy, but the two are highly correlated. And if we did see a material slowdown in growth there, or a negative surprise that could likely have negative implications for risk assets. And then finally, one interesting stat, after Putin had announced likely calling up 300,000 reservists, you saw a spike in one-way plane tickets from Russian airports to countries that do not require a visa. Prices for those skyrocketed in a matter of minutes before being quickly sold out. A very interesting take. I think that speaks to what is maybe the Russian nationalist opinion on this conflict. Obviously, the toll that it's taking on both their economy and their stance in the world. That's all for this week. As always, happy to discuss anything else in more detail. If you don't connect, have a great week. Take care.